one thing so that anybody who did not get to watch live will be able to catch all the good, juicy details afterward. So welcome everyone to the Client Tax Update and 2023 Season Planning webinar. Most of you, of course, know me. I'm Jared Rogers, CPA, head up this place called Wilson Rogers and Company. And what we like to do every year is we like to give everybody the opportunity to learn what's new, not only about the tax law changes, but what may be changing with our office and things to help you make sure that you plan for a very smooth tax season. So a couple of things, just housekeeping things to note. We've muted all of the audio lines and we've killed all the cameras, but you are more than welcome to type in any questions that you might have as they come up into the chat window. And I will make sure that I answer all of those when we get to the very end of the presentation. So you're more than welcome to ask anything that's on your mind. And like I said, we'll take care of that when we get to the end. So let's go ahead and hop right to it because I want to make sure that I'm mindful of the time. So what's on the agenda? We're going to start out by looking at tax season 2023 for tax year 2022. We're going to review some of the key dates and things that you need to know. We're going to go over how the tax law changes may impact your 2022 tax filing. And then we're going to go, lastly, we'll go over changes in operations, packages, pricing, and all of those good things. So I want to make sure that we hit all of the tax changes first, so that if you do need to leave, you'll at least get all of the good information, because you can always ask us, like, you know, when our office is open and yada, yada, yada. So first thing to note, important filing season information. The IRS has already opened up tax season. It started last Monday, January the 23rd for individual tax returns. For business returns, meaning 1120s, 1065s, 1120Ss, it was actually opened, I think, a week prior to that, which means that this filing season will be a little over 12 weeks. I'm looking at my nice little handy dandy wall calendar, and it says February the 1st, which means we have 76 days left in tax season. Yes, so it goes by fast. And yes, we do mark off on the calendar each and every day as we get closer to the end. The next thing to note is that deadlines. So deadline to file your return or extend it, which does not necessarily extend the deadline to pay. So what I mean by that is, if you have a tax return, you have a balance due, so you owe the IRS, and you decide that you want to extend that tax return, so you need additional time to file the return, okay? You can extend it, and that'll take you either out to September the 15th or October the 15th. But if that balance is due, it is due April the 15th. So that means that you are either going to want to make an extension payment if you can't, you know, get everything done by the 15th, or you just want to outright pay it. Another misconception that people sometimes have is, oh, I know that I'm going to owe, so therefore I'm just going to wait until April the 15th. Well, actually, what I usually tell people is, if you believe that you're going to owe, file early. That way you can figure out exactly how much you owe. You can figure out if you can pay that balance before the 15th, or if you need to do something different, such as, you know, go on a payment plan or request IRS, you know, help with that. And just like your cell phone bill, you know, Verizon doesn't come after me until after my due date, okay? And it's the same thing with the IRS. You can file at any point in time up to the deadline and have a balance due. The IRS is not going to ask about that balance until after you pass the 15th, which brings me back to the due dates. So Wednesday, March 15th is the deadline for S corporations, partnerships, and multi-member LLCs. So if you file a tax return 1120S or 1065, your due date is March the 15th. If you are an individual, your due date is Tuesday, April the 18th, okay? And that is for individuals and C Corps, anybody who's filing a Form 1120. So the reason this happens is because the 15th happens to fall on a weekend. DC celebrates Emancipation Day on that Monday. And because DC can't file, that means that the US can't file, which pushes it out to the 18th. So we all get a little bit more time. All right. We're currently open from 9:30 a.m. to 7 p.m. Central Standard during the week, and we are open 9 a.m. to 5 p.m. on Saturday. We are closed on Sundays. So if you have any questions, just feel free to call the office. Takira or anybody else who answers the phone will be able to help you. And our client email address, which is clients@wilsonrogers.net, will be up on the screen at the very end. So you can always shoot us an email and we'll get back to you. Due to the fact that we get extremely busy post March the 1st, everyone is encouraged, implored to actually file early. And we do provide some great incentives for people to do that. And we'll talk about that a little bit later. So let's go ahead and help out all the business folks first. So anybody who files a business return, meaning primarily, you know, the corporate returns or the partnership returns, there's not a ton of changes, but there are some things that you might want to be aware of. The first is that traditionally, when you had a business, you could deduct at one point in time meals and entertainment. Then it just switched down to just meals. So if you do entertainment, like, you know, taking clients out to, you know, sporting events or anything like that, entertainment is no longer allowed. It hasn't been allowed since the Tax Cuts and Jobs Act went into effect. But you could deduct meals for 50%. So whatever you spend on a meal, you could deduct that. Well, the Consolidated Appropriations Act of 2021, due to COVID, increased it so that for 2021 and 2022 only, a taxpayer could deduct 100% of the cost of a business meal that was provided in a restaurant. So it doesn't have to be consumed in a restaurant, but it has to be provided by a restaurant. So if you're self-employed, you file on a Schedule C, you're allowed to do this as well. Okay, but 2022 is the last year. New, which is kind of big for our S Corps and our partnerships, so filing on 1120S and 1065s, beginning in 2021, they were going to be required to file a new Schedule K2 and K3. So this is an additional to Schedule K1, okay? And K2 is the partner's distributive share of items international, and K3 was the partner's share of income deductions and credits international. And what this, long story very short, when you had a business that had international items of importance, whether that be income, deductions, et cetera, and say you as an individual were taking the foreign income tax credit on your personal return because you pay some foreign income tax. Maybe you got some dividends there in Europe, Canada, something like that, and you would take the foreign tax credit, okay? You allowed to take a credit for the taxes that you paid to a foreign country. Well, the problem is that there were a number of forms that were kind of all over the place, and the IRS decided they wanted to consolidate all of them into the K2 and the K3. So the biggest thing to know is that the IRS says that we as preparers have to kind of figure out whether or not a member or a partner was going to actually need the K2 or K3. But we, Wilson Rogers Company, have just, due to the rules, we just plan to file them on all the returns, regardless if they've been requested or not, okay? So if you do have a business, just realize that things got a little bit more complex and there's going to be these new schedules that are going to be provided to you in addition to the K1, K1 that you used to receive. The next thing is for businesses. If you received the employee retention credit, so this is another COVID related item where a business, if you kept on employees during COVID, you could apply for a payroll tax credit known as the employee retention credit or the ERC. And you may see this on TV where people are saying, hey, if you kept employees on, you can get $26,000 per employee. And people may have received those credits. The one thing to know, though, is that the IRS has said that the employer's deduction against income for qualified wages must be reduced by the amount of the credit. What does that legally basically say? It says basically you have to reduce the wages claimed by the ERC received, but it has to be done on the original return. So for example, if you received the ERC in 2022, got $26,000, but it was related to a 2021 tax return, you're not going to claim it as income in 2022. You actually got to go back and amend the 2021 tax return. We're actually working through some of these right now. It's not necessarily fun, but just know that if you got the employee retention credit, you might need to amend your return. Net operating losses generated in 2018, 19, and 20 that were being carried forward into 2022 are going to be limited to 80% of taxable income. This isn't new, but this is just something I wanted to highlight again. And then due to, on the individual side, individuals having their state and local tax deduction. So if you itemize and you claim state and local taxes, so state taxes taken out of your check, property taxes you pay on your property, those are capped at $10,000. They have been since 2018, if memory serves me correct. The thing with this is that there was such an uproar in high income taxing states such as California, New York, Illinois is 4.95%. So we're no slouch, but you're paying state income taxes and it's being limited. So what ended up happening is they've gone ahead and certain states have created a pass-through entity tax that can provide some personal income tax relief to the owners of those entities. So just know that if you have a business, there's an opportunity for you to potentially pay the taxes for your owners at the business level and have it come through as a deduction for them so that, they can kind of get a workaround on the state level. All right. That's all we've got on the business side. Tax planning. So we often get the question, what can I do to save on my taxes? How can you help me save on my taxes? And what I usually tell people is that after December 31st, there's really not a whole lot that we can do to save on taxes. But what I can do is I can tell you what you can do in 2023. So when we have this conversation in 2024, you may have been able to do some things. So just very minimal. Retirement contributions. So if you are still working, you can contribute more to your retirement accounts. So in 2022, for say like a 401k or 403b, you used to be able to contribute 20,500. That's been indexed up to 22,500. And if you're over the age of 50, there's a pretty sweet catch-up amount. You can contribute another 6,500. So you can contribute up to $30,000 into your 401k or 403b. If you contribute to an IRA, you can contribute 6,500 this year versus 6,000. And if you are a business that has a SEP, that has massively been indexed up from 61,000 to 66,000. Still limited to 25% of your wages on your W-2, but pretty big uptick there. So retirement plan, if you can contribute to it, is going to help you save on taxes. The Secure Act 2.0, what this is that there was recently a tax law. The Secure Act is like the second version of it. But one of the most notable provisions of it is that for those who are of retirement age or who are approaching retirement age, they're required to take what are known as required minimum distributions, or RMDs. Okay. And RMDs used to have to be taken at when a person reached 70 and a half. Then there was a law that changed it to 72. Well, the Secure Act 2.0 is now moving that to age 73, beginning January 1st, 2023. And then in 2033, the RMD age will increase again to 75. So just knowing that if you or someone that is approaching retirement has to take RMDs in 2023, you don't necessarily have to because the age is moving. Okay. We kind of talk about the catch-up contributions. The bill also increases catch-up contributions for individuals aged 60 to 63, beginning in 2025. I know that's not 23, but basically, if you looked at it, say an individual who could qualify to contribute an additional 50% of their regular catch-up contribution limit, which kicks in at age 50. So if the provision were in place for 2023, that means that somebody who was 62 years old could contribute the maximum to their company 401k of 22,500, plus a catch-up contribution of 7,500, plus an additional 50% of that catch-up contribution, or 3,750, for a massive 33,750. So once again, just kind of planning out, retirement contributions are going to be something that are going to be indexing and going up. And because it happens on a pre-tax basis, this is stuff that comes out of your check. This is something that reduces your taxable income. So not only does it help you save for retirement, but it also helps you save on taxes. Okay. Health savings account. So anybody who has a high deductible health plan, you will know it because, through your employer, you like the deductibles that you have to pay. But if you have an HSA account, the amount that can be contributed to that account is $38.50 if you're under age 55. If you have a family under age 55, it's $77.50. My wife and I actually do have an HSA. I'm on her health insurance, and she does have a health savings account. And what this account basically allows you to do is allows you to put money into it so that you can then pay for medical expenses. Okay. So you put it in, and when you have a medical expense, you use the account. It can only be used for medical. Otherwise, you face penalties. But the numbers are going up for that. Also, you can contribute to an HSA and potentially receive a tax write-off for it. We handle that all on our side. Nothing for you to do, but just something to know. Just like if you contribute to an IRA, you may also be able to get a write-off for that contribution, depending on certain income limits, etc. But these are some of the things that you can keep in mind for 2023 as you are trying to plan on saving taxes. Real quick, standard deductions are being indexed for inflation. We all know that inflation has been through the roof. So your standard deduction, which is basically, you can think of it as the amount of money that you do not pay any tax on. So for example, if you have a young college age kid or dependent, they go and they earn $6,000. They would have to file a tax return as quote unquote single. And what this would mean is that they would not pay taxes on the first $12,950 that they earned. Okay. So standard deduction, single, $12,950, married, filing joint, or qualifying widow or widower, $25,900, and head of household is $19,004. The standard mileage rates, the most notable thing on this is that they were split. Because of inflation, the IRS indexed the rates to make the mileage rate higher, and it happened about halfway through the year. So if you drove for, say, business before July 1, you would get 58.5 cents per mile off. If you drove after June 30th, it's 62.5 cents. Charitable mileage is 14 cents, and medical mileage, so if you had to go to the doctor or anything like that, is 18 cents per mile before July 1 and 22 cents after that. All right. Kind of along this line is our YouTube resource. So sometimes people will say, hey, do I take the standard or do I itemize? Which one am I supposed to take? And we just did a video on that. So cut your tax bill, standard versus itemized deduction tutorial. That's out there. And we also have 2 other videos that have been doing well. The one on the left, CPA says how to structure your business, part 1. I'm doing a 3-part series on setting up a business. The first talks about entity structure. The second talks about, it's already out, talks about how to actually set up your business. And then the third is going to talk about the tax implications. So for example, a person who sets up an LLC may say, hey, I set my business up as an LLC because I wanted it to be separate, and they get to tax time and they find out that it's on their personal tax return and they're going to be responsible for the taxes. So it wasn't intended, but that's what happened. And that's what the third part of the video series talks about. That should be released next Monday. And then for those who are self-employed and maybe don't know how to file a self-employed tax return, I did a tutorial. It's about 15 minutes, but I think it's very good. And apparently other people think it's very good because it's gotten a good amount of views in comparison to our normal, 10, 15 views per video on self-employed tax returns. So our YouTube channel link is down at the bottom. You could just, if you're in YouTube, you can just search for Wilson Rogers and Company, or you can go to youtube.com/C/Wilson Rogers and Company. Just because some people may have joined afterward, because the lines are muted and the cameras are off, I am going to address any and all questions at the end. So yes, just simply type them into the chat and I will make sure I get to them when we get to the Q&A piece of it. All right, let's keep moving. The one thing that I often talk about are cap gains tax rates. And this is because you may have been involved in cryptocurrency or the cryptocurrency meltdown. You may be involved in stock. You may have dividends that you receive. And a lot of people know that, they say, hey, I want to earn money like the rich. I want to be taxed like the rich. Well, a lot of the rich and the wealthy receive a good majority of their income via sources that are going to pay them income that is going to be taxed at capital gains. Okay. So the thing to note is that the cap gains rates are for long-term capital gains and for qualified dividends. And for example, you can see if somebody is single and if they had capital gains, but they earn in total less than $41,675, they're not going to pay any tax on their capital gains. And it doesn't make a difference what the amount is. You can have $1 million, they're still going to be taxed at zero. Well, actually that doesn't work, but the point is that if you have certain income that you're receiving that's subject to long-term capital gains or qualified dividends, you're going to pay a much lower or favorable rate. Okay. And for the gains to be considered long-term, The asset has to be sold or disposed, must have been held for longer than a year. Okay. So just more than 365 days qualifies it for long term. So if you had cryptocurrency, it ran up and you were thinking about selling it, if you sell it on day 366, you're going to get a much more favorable tax treatment than if you sell it like 90 days in. Okay. And then lastly, the brackets shown take into account all of your income sources, but the capital gain portion is only taxed at the appropriate rate. So this is why I kind of reverted on the first statement. If, for example, you earned $20,000 in dividends and you earned $20,000 as a W-2 employee, your total income is $40,000, okay? And you're single, that's going to put you in the 0% cap gains rate. So it looks at all of the income, but the capital gains piece of it, which is only 20,000, is going to be taxed at 0 rate, okay? The remaining 20,000 is going to be reduced by your standard deduction or your itemized deduction, and then it's going to be taxed at your ordinary income rate, okay? So just something to keep in mind in terms of, you know, where you're getting your income from. Always consider investment income because it's taxed more favorably. All right. A couple other quick things before we get to the quote unquote major changes for this year. Our educators, most school teachers know that they can deduct up to $250 of qualified education expenses. So things, supplies, things that they spend in the classroom to do their job. They've known it to be $250 for, you know, for as long as I've been doing taxes, and that's 20 something years. That's finally gotten indexed up to $300. So it's been indexed up to $300 per spouse. So if you and a spouse are filing married, filing joint, you can write off $600 of qualified educator expenses. But the maximum deduction is $600. Okay. And neither spouse can deduct more than $300. If you live here in Illinois, the state of Illinois is still allowing an additional deduction at the state level, which means you kind of get to double up. But we have questions on our organizer where it asks, you know, what school did you teach at? How much did you pay? You know, so that we can get you that state level deduction if applicable. This is the exact same slide from last year. The pictures are the same. The only thing that changed was one of the year numbers. And why would Jared do that? Because I made this presentation at midnight, and no, that's not why. It's because this is still in play. So anybody who took a COVID distribution, meaning that you took money out of your retirement account, you were allowed to take up to $100,000 out of a retirement account and not be penalized 10% early withdrawal penalty. You still had to include it in income, but you weren't going to get penalized at 10%, okay? And then you could either take the hit in 2020 on the 2020 tax return, or you could spread it 20, 21, and 22. Or, yeah, even adding more complication to the mix, you could repay it and then not have to pay anything, but you have to amend the returns. What all of this even simply means is that if you did not elect to include it 100% on your 2020 return, you're going to have to include the last piece of it, the last third on the 2022 return. We have all the prior history for anybody that took this, you know, so you don't need to worry about it. But if you were coming to us as a new client, you know, and you had this in play, this would be the last year that you potentially have to include that income. And then, yeah, taxpayers could recontribute any portion and then within the 3-year period and not have to worry about it. But, all right, key tax benefits changing. So the one thing to note was that on March of 2021, the American Rescue Plan Act, which was signed into law by President Biden's administration shortly after he took office, was designed to help give additional relief as it related to all of us who were struggling with COVID, okay? This is the one that gave us the third round of stimulus payments, and it also increased several different provisions, okay? Now all those provisions are reverting, so they're going back down, which means that if, for example, you had a family, you had several children that were on your tax return, you may have received some massive tax benefits on the 2021 return. Those things are not going to be there this year. So a lot of tax professionals, when they were doing like, you know, videos and announcements this year, they were letting everybody know that, you know, your refund might go down significantly. And that's true. So these are some of the things that you are going to want to just keep an eye on, and we're going to go deep into each one right now. Okay. So some of the benefits that are going to be changing are the child tax credit. So if you have children that you claim on your return as dependents, that's going to be changing. Child and dependent care credit. So if you're paying for care for either your child or for an elderly parent, that's going to be changing. The earned income tax credit, it's going to be going down. The recovery rebate credit, sick and family leave credit, and charitable contribution deductions are also going to be adjusted. So let's go into those. So the child tax credit. So for 2022, the credit is basically reverting back to the benefits available prior to the American Rescue Plan Act, which basically means that for each qualifying child, you're going to basically be able to receive a maximum of up to $2,000. Okay. It was, don't quote me, it was like $3,000 and $3,600, depending on the age of the child. And it was also advanced in 2021, but that is no longer the case. So now it's reverting back down to a maximum of $2,000 per child between 2022 and 2025. Each dependent must be below the age of 17. It is refundable, so meaning that if your tax liability was reduced to zero through like your standard deduction, itemized deduction, and all those credits, you could get a piece of it back to you regardless. So that's the refundable portion, but it's refundable up to $1,400, but it's no longer fully refundable, which basically means that depending on how much income you earn, they may not give you all of it. As I indicated, there were no advance payments, thank goodness, because just reconciling all that stuff on tax returns was a little bit, hectic. Did you get the advanced child tax credit? How much did you get? Do you remember? Do you have your letter? Yeah, all that stuff. Not glad that we don't have to do that this year. And then the credit is available if you earn up to $200,000 as a single taxpayer or had a household, $400,000 if you're married, filing jointly. All right. Next on the list is the child and dependent care credit. So this one was super massive in the sense that in 2021, you could potentially get like $8,000 back per child for paying for daycare. Okay. But those numbers are going back to what I remember, quote unquote, as the normal levels, which was only the first $3,000 worth of expenses per child count. So if you send your kid to daycare, they're only going to look at the first $3,000 that you spent, not the fact that you sent $19,000, potentially. And then it's up to 35% of the $3,000. So for most people, I used to remember it was like, you might be looking at 20% of $3,600 per kid, would be the maximum that you get. So we're going back into that realm. And then the credit is going to be reduced for incomes that are over $15,000. All right. The earned income credit, or the EITC. So what the earned income tax credit is for those individuals who are on, may have lower incomes and may also be supporting a family. The earned income credit is designed to help assist those people. It's a government, quote unquote, subsidy, but it helps people, keep more of their money and get a little bit more of their money. All right. And under COVID, the EIC was actually expanded so that workers without kids could nearly triple the maximum credit that they could get without those kids. And then the eligibility also was extended to a wider range of filers, allowing taxpayers without kids to qualify if they were over age 65. And then people who were between the ages of 19 and 25 could also potentially qualify, which had not been the case. So now we're going backwards to quote unquote normal. For tax year 2022, the age requirement works back, meaning that if you do not have any children, you have to be 25 years or older, and you have to be under 65 in order to claim it without a child. The prior year income cannot be used to help you qualify for the credit. So what happened during COVID was if your income was lower because of COVID and your income in a previous year would have qualified you for more of an EIC, you could use the previous year's income number to get a bigger EIC. Well, that's not happening. And then the amount of the earned income tax credit is adjusted for inflation every single year, and it's going to be up to $6,935 with 3 or more kids in tax years 2022. Okay. So if you know somebody who's, doesn't necessarily earn a lot, has dependents, this is a very worthwhile credit to pursue. The one thing to know is that, unfortunately, because people or tax preparers sometimes attempt to game the system, and the way this is done, more information than you want to know, is you say, oh, you've got 3 kids. If I get your income to be this, then you're going to get the most amount of credit. So you're going to be a barber or a hairstylist, or you're going to do something where we can say you made some money. Okay. And then they would get the amount to be right where it needed to be and get you a super massive refund, and then usually charge you like $1,000 to $2,000. But they would say, don't worry about it. I'm just going to pull it out the refund. You'll never know it's gone. Or shady preparers wouldn't even tell you. So because the IRS knows that there's the potential for fraud with the EIC, the one thing to know is if you do qualify for the earned income credit, the IRS is not going to release those refunds to people before mid-February. Okay. So it just gives them more time to look, make sure that the dependents that are listed there should be there, and that, there's no hanky-panky or anything else going on. But once again, just know that EIC related refunds are going to be delayed. Okay. So what provisions are 100% expiring? So I just kind of put these together as questions that people might have. So was tax year 2021 the last year I could claim the recovery rebate credit? And you might be going, what is the recovery rebate credit? So for tax returns for tax year 2020 and 2021, you may have gotten, or were supposed to get, a stimulus check, but you may not have gotten your stimulus check because you may not have filed a 2018 or 19 return when the pandemic hit. So they didn't issue a stimulus check, or you may not have filed returns in a while, or you may have moved, who knows, but you may not have gotten your actual stimulus check. Well, the recovery rebate credit allowed an individual to request those stimulus payments on their tax return and get a refund that way. Okay. So that's what the recovery rebate credit was. So for example, if you were eligible for the third stimulus payment of up to $1,400 for you or your dependent, and you didn't receive your stimulus payment, you were able to claim the recovery rebate credit on your 2021 tax return. Okay. But that credit is not going to be available for tax year 2022. So there is no recovery rebate credit. There were no stimulus payments, none of that stuff. So that is gone. Was tax year 2021 the last year I could claim the self-employed sick and family leave credit? This is for business owners. The American Rescue Plan Act extended this through tax year 2021 for both eligible self-employed and small business owners, but the credit has expired after tax year 2021, so it's not in play on this tax return. And then lastly, can I still deduct up to $300 in cash donations if I claim the standard deduction? So the pandemic adversely impacted charitable organizations, So, hey, everybody was out here struggling. Well, maybe not everybody, but a lot of us were, struggling out here. And charities were not able to get some of the donations that, they were used to getting. So people who may have itemized their deductions weren't, they weren't contributing to charity. And as an incentive to try and help the charities still get some of their funding, the IRS, your legislators basically said that if you did give charitably and you were usually taking the standard deduction, so you weren't itemizing, because that's usually the only way you could get it, you could get up to a $300 above the line write-off for giving a charitable donation. Okay. And it was $600 married filing joint. Well, for 2022, the only way you can get a charitable write-off of cash is if you itemize. Okay. So that provision is gone no more. All right. So now this brings us to the very last piece before we jump into any of the Q&A type stuff. So if you do have a question, you go ahead and you can type it into the little chat window now. That way I'll be good and prepared to handle all of that good stuff. But some things to note for 2023, who do we have here in the office? So if you call the office and you hear a lovely voice on the other end, it's probably not me. It's more than likely Takira. She's our administrative assistant. She can help you with any and everything, whether that's a password reset, getting into your portal account, setting up some time that you need to talk to me. If you needed to schedule an office appointment or office visit, she can take care of all those good things for you. Okay. Then we have Daisy and Jesse. Those are our two tax interns. They join us from St. Xavier University. We've had a program with that university for approximately 4 years now. And we also have one with Chicago State University. But those are our two interns. So they are both within the finance and accounting realm. They're students. They are learning the ropes. And Jared is trying not to give them a bad impression so that they say, I never, ever want to do taxes. But no, all jokes aside, they'll be helping us with preparing tax returns. They're here learning all of that good stuff. So if you do get a portal message and it says, Daisy or Jesse, just know that they're assisting working on the returns. We have rejoining us for this tax season, Toya Simmons. She's our lead tax preparer. So a lot of the questions as it relates to your initial prep may come through the portal through Toya, or she may give you a call. So if you get a call or a message, just please respond promptly so that we can go ahead and keep your tax return moving. This year, Jared is kind of transitioning what I do, and we've brought on 2 bookkeepers to help us with our bookkeeping clients. So Jeremiah Hartney and Ken Wagner are the 2 bookkeepers that we have here. So if you are a business and you get bookkeeping services through us, and you've gotten some emails recently and you're like, who's Jeremiah? Who's Ken? Those are the individuals that are on the bookkeeping side. And then, of course, there's me back once again to try and make this ship float, run, and get through tax season, hopefully less unscathed than we've had in 2021, which was a dumpster fire train wreck, and 2022, which was a challenging year, but not as challenging. But yeah, hoping that we are quote unquote getting back to more normal, as evidenced by our staffing and the like. All right, so let's look at pricing right quick. I sent out an email around January the 4th. It comes from our client relationship management, or our CRM system. If you ever see any emails coming through and then down at the bottom it says like HubSpot, that's the CRM system. The funny or funky thing about that system is that it doesn't do real well with individuals that have Gmail addresses. Gmail spam filters catch it really hard and send it to junk. But the whole point of this is that on or around January the 4th, I sent out an email that had everything that you would need to file your taxes. It had a video from me in there. It had our organizers, whether it's the PDF, the online jot form link to it. Those were all there. And anything that you would need to know, our pricing, it was all in there. If you didn't receive that email, you can't find it, and you want another copy, just email us. I'll put the email address up on the next slide. clients@wilsonrogers.net will gladly resend it to you so that you got everything. But our pricing is changed this year, just like everybody. But standard returns, so W-2s or retirement income only, those are $250. Intermediate is if you have minimal stock and dividends, if you had a Schedule C or a business with less than $5,000 in income, if you had a Schedule E, meaning you got one single rental property, or if you had significant credits that were excluding the earned income credit, or you itemize, that's going to place you in intermediate. And then advanced is like substantial stock, think stock, crypto, any of that stuff. If you have a Schedule C that had greater than $5,000 worth of income or expenses, or if you have multiple Schedule C activities, if you have a Schedule E with multiple properties, if you had significant credits, including the earned income credit, or if you itemize deductions, that's going to be on advance. Now, going back to the very beginning where I said we provide some very good incentives for people to reduce the amount that you pay us. I believe in being fair. We actually indexed the discounts. So last year, I think they were $50, but we indexed them for inflation as well. So if you start or have your taxes done or prepared by the dates that are listed, you get 55, 45, 35, 25. So we incentivize you to start early. We have more capacity at the beginning of the tax season than we do at the end. It's not the same for all tax offices. So for example, a lot of the chains, you can think H.R. Block, Liberty, Jackson Hewitt, they tend to, depending on the office, be busier at the beginning of the tax season. And I know many preparers who work for those offices that by the time they get to like April, they're busy, but they're not as busy had they at the beginning of the season. We're reverse. We get worse as the season goes on because we got people that have rental properties, more complex situations, you know, you name it. But we get really, really jammed up starting around like the March 1st area and then March 15th, because that's the corporate deadline. We get really, really jammed up. Okay. So basically, all I'm simply saying is if you have your documents and if you can send them to us earlier versus later, you get the maximum amount of discount. So filing by, starting the process by Valentine's Day, then 3/14, 3/31, and 4/18. After the 15th or the 18th of April, no more discounts, you know. But and when I say start the process, what I mean by that is the organizer that we sent out. If you submit the organizer, say before the 14th of February, and you submit most of your documents before the 14th of February or shortly thereafter, then we would give you the $55 discount. Okay. What we don't do is if you only send in an organizer on like January the 31st or February the 1st, and then don't send any of your other documents in until April the 5th, you're not going to get the January discount. You would get the discount for $25 because most of your data is really coming in there. So send in most of your data. If all you're waiting on is a K1 or a dividend statement or something like that, you know, we'll give you the discount that applies to that majority period. We just don't want, you know, data coming in way late, you know, with regards to that. Okay, so that brings me to the very end. And for once, Jared did not talk for a whole entire hour, but that too is because there wasn't necessarily a ton of things to discuss. A lot of it is just simply reverting back to pre-pandemic levels with regards to a lot of these credits. My information is, of course, on the screen. So if you needed to reach us, you've got all that. Take out your smartphone, take a picture. I know you all know how to find me. But if you needed to refer somebody. Now, just note that email address, clients@wilsonrogers.net, that is specifically for you. Okay. So if you have somebody who is a prospect, you know, you can go to wilsonrogers.net, and at the bottom of the website, customer assistance at wilsonrogers.net is the address that you can give them. You're more than welcome to give them the phone number. You can follow us on social media, you know, whether it's Twitter, Facebook, Instagram, YouTube, or our website, wilsonrogers.net /blog, ask an account. We got 180 something articles there as it relates to tax things that I've talked about, most of which are being transitioned over to YouTube. Just as an aside note, in the email that I sent out, I think I've actually sent a couple, but the email that I sent out in January, I mentioned that we had finally launched our money management website, which is makemoneymakesense.com. That really was the point of all the YouTube videos, is to be housed in that site. So now that site is open, it's active, the YouTube videos are there, as well as the courses. We're making courses. The first one is like how to file back tax returns, a step-by-step guide. And then the next course, which is in process, is how to set your business up from an entity and tax perspective. So makemymoneymakesense.com is another good resource for you. All right. So once again, if you have any questions, go ahead, pop them in the chat. Let me go ahead and jump over there and see if there is anything that I can address. So that's a very good question. So the question is, if you started to take your RMD due to age, will you be able to stop taking your RMD for an additional year for 2023 due to the higher age requirement? So if I think about, this is going to be very close. So if somebody, let's say, for example, in 20, will that work? I think so. If somebody in 2020 was turning 70 and a half, 21, 22, yep. So somebody was turning 70 and a half in 2020, and they were required to take their RMDs under the old rule, and then it got moved to 72, and now it got moved to 73. So you're not going to be 73 by 2022, but you will be in 23. Could you potentially pause taking that RMD? And the answer to that question is I do not know, but I would think that it's possible. So I know who you are. I will go ahead and I will do some quick research on that, and I will make sure that I shoot you over an answer about that specifically. Okay. And yes, if you unfortunately had to miss a piece of the the presentation, yes, this has been recorded. And yes, I am going to load it, and later on today I'll be sending out an email. So once again, it'll be coming from HubSpot, so just make sure you check that. But it'll have a link to that. It'll also have I'm actually throwing in the newsletter because one of the things that we've done recently is our hard copy newsletter, which you all get coming, to your houses and, apartments and condos via USPS mail. We're also delivering that electronically. So when we sent out the January 4th email, it was included in there digitally. And we have, all of our clients' emails. So, the only people that wouldn't get it is if they didn't have an email. Or like I said, if the message was going to junk mail. But outside of that, yeah, this has been recorded, and we will be putting the replay out there. All right. So anybody else with any other questions and the like? Let's see. True. Yeah, there were a lot of the market didn't necessarily do well for those that were in it. And when I say market, whether that's the stock market, and depending on what you were invested in, definitely the cryptocurrency market, there were a lot of things that may have taken a hit, so retirement accounts, IRAs, 401ks, all of those may have seen a hit in a decline in value because of that. So yeah, it would be good for any of those investments to try and recover. But one of the things that I do tell people is we primarily play in the tax space. We're primarily on the tax side of the house. Okay. Now that doesn't mean that, Jared doesn't know anything about investments, doesn't know, about the tax implications of those investments. But what I usually will say is that if you have an investment type of question, it's always helpful to have somebody in your corner, whether that is YouTube or whether that's a financial advisor. Okay. So if I ever have like something going on with my portfolio, I can take advantage of those services of calling up my advisor and speaking to them and letting me know. The last time something major was about to happen, I had spoken to my advisor and they said, what, you might want to consider repositioning your portfolio. Now, nothing happens without cost. Okay. So to reposition a portfolio, yes, you're going to have to sell, and yes, you may incur some charges. Okay. But I ended up doing it like right before there was a pretty sizable market correction. I want to say this was like it wasn't 2020, it was 2019. And I moved my portfolio around so that I wasn't as heavy in, say, like growth stock. Okay. And it turned out to be, a very good and smart move. Not one that I would have come up with on my own, So if an individual does have concerns about, like their portfolio, if you're nearing retirement age, if you already are at retirement age, if life is becoming more expensive, whether that's through just inflation or that's through medical, things like that, have a chat with your advisor. If you do not have an advisor, then feel free to reach out to us. We have individuals that we can put you in contact with and see if maybe there's something that, could be done to, help better balance. By the time, you get into, withdrawing from retirement, especially depending on the age in which you are and the size of your portfolio, and I hate to say this, life expectancy, you may want to reposition a portfolio so that you are preserving the principal. In finance, that's the one thing that we always say: preserve the principal. What's rule number 2? See rule number 1. So you always want to preserve the base. And it's not always possible to do that, especially with investments. Investments involve risk and they are volatile. But it's just something to know that, if you are heavily relying on your base, or you don't want your base to erode, then you may want to reposition. I'm not going to get into it because that's not my forte, but just simply meaning moving into less volatile, say out of stocks, maybe into something that's more income producing, or maybe just something that's, very stable, quote unquote, cash related funds. But all good things. But yeah, if you need a resource or anything like that, feel free to reach out to us. If you already have a resource, reach out to them. All right. All righty. Coming up on the end, anybody else got anything else that's on their mind that they'd like to potentially get an answer for? Going once, going twice. Sold. All right. Thank you, everybody, for taking the time out to attend. Hopefully you did get some value out of it. Yes, I will go ahead and post it to YouTube. It'll be private. You will get an email for it. If, for example, you don't get the email and you just like desperately want to get a copy of it, just let us know. We'll email you the link, okay? And that way you can share it to your friends or anybody else and just be like, hey, did you pay attention to any of this stuff? And then you can be like, my accountant's awesome. And I can be like, I try. So, all right, that is it. Thank you very much for taking the time out of the day. Thank you for all the very kind words. We are looking forward to hopefully having a very, very good tax season, very uneventful, and hopefully very streamlined and straightforward. You all take care, stay warm, and we will see you all next time. Have a good one.